Hi students, this is here 2017 July Kerala State Eligibility Test Economics Previous Year question. This is your part number 3. In this part, we are going to discuss from question number 81 to 120 question. So let's start the video. So question number 81. Today's first question number 81. Lorentz ratio ranges in between 0 to 1, minus 1 to plus 1, 1 to 100 or 0 to minus 1. Lorentz curve generally it ranges from 0 to 1. Lorentz curve, you know that this is the shape of the Lorentz curve. This is perfect equality line and this is the inequality line. So Lorentz curve measure by Gini coefficient, it ranges from 0 to 1. 0 means perfect equality and 1 means perfect inequality. So it ranges from 0 to 1. Then question number 82. Identify the odd one: binomial distribution, exponential distribution, t distribution, normal distribution. So odd one is binomial distribution, because binomial distribution is a discrete probability distribution, while other like the exponential distribution, t distribution and normal distribution, these are all continuous probability distribution. So exponential, t distribution and normal distribution, these are continuous, and binomial distribution, it is a we can say discrete probability distribution, and these all are continuous. So option A or binomial distribution is odd one here. Then question number 83. GNP8 factor cost. GNP8 factor cost means GNP8 market price plus net indirect tax. No, GNP8 factor cost minus consumption fixed cost. No, GNP8 market price minus net indirect tax. Yes, GNP8 market price minus indirect tax, it is called as factor cost. Factor cost means initial cost of production of the particular good. And if we find that from GNP8 market price, if we deduct the net indirect tax, means tax plus subsidy, this is called as GNP8 factor cost. When we deduct from GNP market price minus net indirect tax, we get GNP8 factor cost. Option C is right here. Then question number 84. The concept of quasi-rent was introduced in economics theory by quasi-rent given by Alfred Marshall. First answer is right. Quasi-rent given by Alfred Marshall. Quasi-rent means it refers to the income generated by a factor of production that is inelastic in supply in the short run, particularly in the context of land and fixed capital. Total revenue minus total variable cost, quasi-rent. So it was given by Alfred Marshall. Then question number 85. The sacrifice ratio shows the relationship between inflation and unemployment. Yes, sacrifice ratio, it shows the relationship between inflation and unemployment, because sacrifice ratio can intend refers to the relationship between inflation and unemployment in the context of the Phillips curve, which suggests that there is a trade-off between the two variables, inflation and unemployment. So sacrifice ratio shows the relationship between inflation and unemployment. Then question number 86. The LM curve is steeper when the demand for money respond. LM curve is steeper when demand for money respond weakly to income and strongly to interest rate. No, LM curve is steeper when demand for money respond strongly to income and weakly to interest rate. Yes, this is the right option. Option B. Then question number 87. Debt financing by bond issue merely postpones taxation in many instances is strictly equal to current taxation. Debt financing by bond issue merely postpones taxation and in many instances is strictly equal to current taxation. It is called as Keynes effect, Keynesian cross, repercussion effect or Ricardian equivalence. It is called as Ricardian equivalence. Option number D. Because Ricardian equivalence is the economic theory that suggests that when a government increases debt financing through bond issues, individuals anticipate future taxes to pay off the debt. Therefore, they increase their savings to prepare for their future tax liabilities, making the impact of government borrowing effectively equal to current taxation. So it is related with Ricardian equivalence. Then question number 88, list 1, list 2. First one is Paul carries Robert, James Tobin, Robert E. Lucas, and Anna Southward. So Paul C, PC Robert, it is related with supply side economics. Yes, Paul Craig Robert related with supply side. Then James Tobin related with Keynesian economics. Then Lucas related with new classical macroeconomics, and Anna Southward related with monetarism. So A1 B for C3 D2, it is in the option number C. Then question number 89, Keynesianism is temporary deviation from the mainstream of scientific progress in economics. This view is held by supply side economics, monetarism, radicalism, or new monetarism. This statement was given by radicalism, because as a radical economist often critique mainstream theories including Keynesianism and advocate for more transformative changes in economic thought and practice. So Keynesianism is temporary deviation from the mainstream of scientific progress in economics. It is the view is held by radicalism. So option C is right here. Then question number 90, list 1 and list 2. Only money matters, money doesn't matter, voluntary unemployment. Only money matters to Keynesian monetarist. Only money matters, monetarist theory. Money doesn't matter according to Keynesian. And voluntary unemployment, new classical macroeconomics. So here 2, 1, 3. Option number B, only money matters, monetarist. Money doesn't matter, Keynesians. Voluntary unemployment, new classical macroeconomics. Then question number 91, at a price of 240 per unit, the shoe company generate additional revenue of 366 rupees for every one additional pair of shoes sold. So the price elasticity of demand is. So here if we calculate first, MR is equal to air. In place of air we can write P. So P ED minus 1 by ED. So MR value is equal to 336 is equal to 240 into ED minus 1 by ED. So if you substitute this value first, we can write 336 by 240 is equal to 36 by 240 is equal to ED minus 1 by ED. We can write this, then cross multiply this value ED into 336. So 336 ED is equal to 240 ED minus 240. Just cross multiply this value. This implies 336 ED minus 240 ED is equal to minus 240. Then 336 minus 240 is equal to 96. 96 ED is equal to minus 240. This implies ED is equal to minus 240 by 96. So minus 240 by 96, if we divide this value, then the value is equal to 5 by 2. 5 by 2 is equal to 2.5. 2.5. So the right option is 2.5. Here elasticity of demand value is equal to 2.5. 2.5 minus value. So ED value is, if we take the value of by modulus, then ED modulus is equal to 2.5 minus 2.5 means 2.5. So here right option is option number D, 2.5. Then question number 92. List 1 and list 2, constant MPC and falling APC, constant APS, lifetime average. So in question number 92, first one is constant MPC and falling APC. Constant APC, falling APC is in the theory of Keynes. Then constant APS, Simon coordinate. Yes, constant APS Simon coordinate related with Simon coordinate. Lifetime average related with Richard Blumberg, lifetime average. So 92 A2 B1 C3. So option number D, 92 D is right here. Then question number 93. This is also a mathematical question. So from the given summary of assumed or union budget, calculate primary deficit and fiscal deficit. Primary and fiscal deficit. So these are the data given here, primary deficit and fiscal deficit. Primary deficit formula is equal to, we know that primary deficit formula is equal to, primary deficit is equal to total expenditure minus total revenue, and fiscal deficit is equal to total expenditure minus total revenue, and primary deficit, formula for primary deficit is equal to fiscal deficit minus interest payment. First one is fiscal deficit. Fiscal deficit is equal to total expenditure minus total revenue, and primary deficit is equal to fiscal deficit minus interest payment. So these are the value you have to calculate. Just put the value and get your answer. So please comment in the comment section what is the right answer for fiscal deficit and primary deficit, fiscal deficit and primary deficit. Then question number 94. A production process with increasing amount of capital per worker. A production process with increasing amount of capital per worker, it is called as capital widening, capital deepening, capital saving, labor deepening. It is called as capital deepening. A production process with increasing amount of capital per worker, it is called as capital deepening. So here 94, right option is option number B. Then question number 95. An overall reduction in the price level as a result of wage cuts leads to rise in the real value of the money asset and increased spending on goods and services is PYQ effect, Keynes effect, Ricardo effect, or speculation effect. It is called as PYQ effect. It is called as PYQ effect because the scenario described refers to the phenomenon where a reduction in the price level, often due to wage cuts, leads to an increase in the real value of the money assets. So this increase in real wealth encourages consumers to spend more on goods and services. So here the correct answer to this scenario is PYQ effect. Then question number 96. In inventory approach to the demand for money is associated with inventory approach. If we see the previous questions, there are different effects. So let's discuss other effects also. First one is PYQ effect. PYQ effect. This effect states that when the price level falls, then the real value of money increases, which can lead to increased consumption as people feel wealthier. Then Keynes effect is equal to, Keynes effect means this effect relate more to the liquidity preference and how interest rate are spending. Then Ricardo effect, this refers to the concept of consumers adjusting their spending based on future expectations of income or wealth due to changes in government policy or taxation. Then speculation effect, this is generally associated with changes in asset prices and expectations, particularly in financial market related with Keynes. So then question number 96, in inventory approach of the demand for money is associated with Keynes, Arthur Laffer, Baumol or Milton Friedman. It is associated with Baumol, inventory approach given by Baumol, because Baumol developed a model of demand for money that emphasizes the trade-off between holding money and holding interest-bearing asset. So this approach treats money as an inventory that individuals manage, balancing the cost of holding cash against the opportunity cost of not investing in interest-earning assets. Then Keynes means it is associated with liquidity preference theory, which emphasizes the role of interest rate in the demand for money. And Arthur Laffer, it is known as Laffer curve, which relates to the tax rate and tax revenue, not directly linked to the demand for money. And Milton Friedman, it is developed the quantity theory of money and emphasizes the role of money supply, but not specifically to the inventory approach. So inventory approach related with W.J. Baumol. So option C is right here. Then question number 97. The vital factor in the decision to spend in the general liquidity of the whole economy rather than the money supply. This view is held by monetarist, Keynesians, 𝙁𝙍𝙀𝙀 𝙁𝙍𝙀𝙀. It is related with 𝙁𝙍𝙀𝙀 because 𝙁𝙍𝙀𝙀, they proposed that the overall liquidity in the economy is crucial for the understanding the spending decision of consumers and businesses. Their approach focus on the broader concept of liquidity beyond just the quantity of money, considering various forms of liquidity and their impact on the economy. So the vital factor in decision to spend of the general liquidity of the whole economy rather than the money supply, this view is held by 𝙁𝙍𝙀𝙀. Then next one is Keynesian. Keynesian means while they also recognize the importance of liquidity, the specific emphasis on the general liquidity of the whole economy, it aligns more with the 𝙁𝙁𝙀𝙀𝙀 prospectively. Then monetarists generally focus primarily on the control and supply of money as the key driver to economic activity. Then 𝙁𝙍𝙀𝙀, they contributed to the theory of money and liquidity but do not primarily focus on the general liquidity aspect in the same way as 𝙁𝙁𝙀𝙀𝙀. So option C is right here. Then question number 98, list 1 and list 2. First, return to a factor. Return to a factor, it is related with all factor input remain constant and one variable. Return to a factor in short run means one is variable and other remain constant in short run. Fixed factor and variable factor both. And return to scale means all are variable. So here all inputs are variable in the long run. So this is in the short run and this is in the long run case, long run. Then isoproduct curve. Isoproduct curve means production indifference curve. Isoproduct curve, it is also known as product indifference curve. Then expansion path, it is called as locus of all possible least combination. Locus of all possible least cost combination, it is called as expansion path. So expansion path. So A3, B1, C2, D for option number D. 98 option number D. Then question number 99, a situation in which the MRS of one good for another is a chosen market basket is not equal to the slope of the budget line. MRS is marginal rate of substitution for one good of another in a chosen market basket is not equal to the slope of the budget line. It is called as contract curve, cooperative game, Carnot solution or Carnot equilibrium. It is called as contract curve, cooperative game or Carnot solution or Carnot equilibrium. It is called as Carnot solution because this occurs when a consumer chooses to consume only one good and none of the other. It resulting in a situation where the MRS is not equal to the slope of the budget line. This typically happens when the consumer's preferences lead them to prefer one good entirely over the other at the optimal consumption point. So it is called as corner solution, because a situation in which the MRS of one good for another in a chosen market basket is not equal to the slope of the budget line, it is called as corner solution. Then other option, contract curve, means it refers to the set of efficient allocation in a bargaining scenario not directly related to MRS or budget lines. Then cooperative game, this comes from game theory. This involves players cooperating to achieve a better outcome, but it doesn't specifically address the relationship between MRS and budget constraint. Then Carnot equilibrium, this relate to firms choosing quantities to maximize profit under competition, not directly tied to consumer choice and MRS. So here option C is right here. Then question number 100, list 1, list 2, perfect competition, oligopoly, monopolistic competition, monopoly. So perfect competition are related with product homogeneity. Yes, perfect competition, product homogeneity, or homogeneous product, produce homogeneous product. Then oligopoly interdependence, because few seller, they are interdependent. Then monopolistic competition, advertisement expense, monopolistic advertisement is a major factor. Then monopoly means no clause substitute, option A3, B1, C2, D4 in the option number A. Then question number 101, tendency of individuals to value an item more when they own it than when they do not. It is called as endowment effect, duality, Patinkin effect, or wealth effect. So it is called as endowment effect, tendency of individuals to value an item more when they own it than they do not. This refers to the phenomenon where individuals assign a higher value to items they own compared to items they do not own. So even if there is no objective reason for increased valuation, means if I have a mobile, then the value of this mobile is more than if I have no mobile. So this is called as endowment effect. Then question number 102, practice of separating consumers with different demand function into different groups by charging different prices at different points of time. It is called as peak load pricing, intertemporal price discrimination, full cost pricing, or second degree price discrimination. Generally this is called as intertemporal price discrimination, because intertemporal price discrimination refers to the practice of charging different prices for the same product or service at different times, targeting consumers with different demand elasticity. This strategy is used to segment the market based on consumers' willingness to pay at different times. So practice of separating consumers with different demand function into different groups by charging different prices at different point of time, it is called as intertemporal price discrimination. Then question number 103, the value of elasticity of demand for medicine is 1, greater than 1, less than 1, or 0. Medicine, we know medicine is a necessary goods. We cannot change the quantity demand. Whatever may the price rise or fall, we cannot shift the quantity demand here. So quantity demand is fixed here, whatever may the price. So here the value of elasticity of demand for medicine is equal to 0, because there will be perfectly inelastic demand. So here the demand is perfectly inelastic. So demand for a good doesn't change in response to price. So elasticity of demand formula is equal to percentage change in price, percentage change in quantity demand by percentage change in price. So percentage change in quantity demand is equal to 0, means quantity demand is fixed. 0 by something is equal to 0. So here the value of the elasticity of demand for medicine is 0. Then question number 104, list 1, list 2, price out decision independent, price output decision agreed, price takers and price war, price rejected. Means price output decision independent in Carnot model. Yes, price output decision independent in Carnot model. Then A for yes. Then price output decision agreed in collusion model. They are agree with price and output decision. Then price takers and price war in the leader follower model. Leader is the price taker, price maker, and followers are the price takers, and price war arise in leader follower model. Then price rigidity arise in the king demand curve of oligopoly. So in the option number C is right here. Then question number 105, a curve illustrating the various amount of a commodity which a consumer would willing to purchase at various income level. Various amount of commodity which a consumer would willing to purchase at various income level called as envelope curve, angel curve, production possibility curve, or contract curve. This is called as angel curve, because an angel curve shows the relationship between consumers' income and the quantity of commodity they are willing to purchase. So it illustrates how changes in income affect the demand for a good. It is called as angel's curve. Then question number 106, rivalry among firms which takes the form of advertising or variation in the product's design or quality. It is called as price competition, non-price competition, price leadership, dominant price leadership. Rivalry among firms which takes the form of advertisement, variation in product design or qualities. These are not price competition, these are non-price competition. Price is same for all, but difference in other like quantity, quality, these are. So non-price competition occurs when firms compete using factors other than price, such as advertisement, product design, quality, customer service, branding. These are happen to differentiate their products and attract consumers by different methods. So this is called as non-price competition. Then question number 107, the failure of the firm to maximize the output produced from it given inputs due to poor managerial motivation and a weak market for knowledge. It is called as X efficiency, internal inefficiency, X inefficiency, or expectation problem. It is called as X inefficiency, because X inefficiency occurs when a firm fails to produce the maximum output possible from its given input due to factors like poor managerial motivation, lack of competitive pressure, or inefficiencies in the organizational structure. So this leads to higher cost and reduced efficiency compared to what is theoretically achievable. So it is called as X inefficiency. Then question number 108, the theory that asset prices reflect all publicly available information about the values of an asset. It is called as efficient market hypothesis, inventory pricing, portfolio pricing, or asset market pricing. It is called as efficient market hypothesis. Efficient market hypothesis, this suggests that asset prices fully reflect all publicly available information. According to this theory, it is impossible to consistently achieve higher returns than the overall market, because asset prices should only respond to new information which is random and unpredictable. So the theory that asset prices reflect all publicly available information about the values of an asset is called efficient market hypothesis. Then question number 109, goods that are rival in consumption but not excludable. In private good, we see a non-excludable, non-rival. In public good, private good is rival and excludable, and public good is non-rival, non-excludable, and club good and common resources. So here, goods that are rival in consumption but not excludable, it is called as common resources. Common resources, because common resources are rival in consumption. Rival means what? One person's use reduce availability for others, but not excludable. Not excludable means it is difficult to prevent others from using them. So common goods, common resources like fish in the river, forest, public grazing area like land, these are the common resources. But these are common resources, but these are the rival in consumption, means one person use reduce availability of others, like fish in the river, or forest or public grazing land. So it reduced to others when one use, but we cannot deny to others. So it is called as common resources. Then question number 110, the curve that shows various combinations of two commodities that an economy can produce by fully utilizing all its resources with the best technology available. It is called as production contract curve, product transformation curve, social welfare function, or grand utility possibility curve. It is called as product transformation curve, because the product transformation curve, also known as production possibility frontier PPF, it shows various combination of two goods that an economy can produce by fully utilizing its resources efficiently with the best technology available. So the curve that shows various combination of two goods that an economy can produce by fully utilizing all its resources with the best technology available is called product transformation curve. Then question number 111, an industry whose long run supply curve is negatively sloped. Long run supply curve is negatively sloped. It is called as loss making industry, constant cost industry, increasing cost industry, or decreasing cost industry. An industry whose long run supply curve is negatively sloped, it is called as decreasing cost industry. Here cost is decreases, because a decreasing cost industry is one where the long run supply curve is negatively sloped, meaning that as the industry expand, the average cost of production decreases. When industry expand, average cost of production decreases due to factors like economies of scale, improvement in technology, or better utilization of resources. So this is called as decreasing cost industry. Then question number 112, higher rate of GST may lead to an, when GST is higher rate of GST may lead to incentive to consumers, no. Incentive to producer, no. Incentive to investor or producer, no. Disincentive to investor, yes, this is right, because higher rate of GST can act as a disincentive to investor, because it increases the cost of goods and services, potentially reducing consumption and overall profitability. So this can lower the attractiveness of investing in certain sectors or industries where GST is high. So this disincentive to investor when GST rate is higher. Then question number 113, which is not an assumption of linear programming? Output and factor prices constant, yes, this is an assumption of linear programming. Constant return to scale, this is also an assumption. Technologically fixed input and factor proportion, yes, this is an assumption. Then increasing return to scale, no, this is not an assumption of linear programming. So option D is right here, because linear programming assume constant return to scale, not increasing return to scale. It assume constant return to scale. So it meaning that output increases in direct proportion to input. So increasing return to scale, it is not an assumption in linear programming, as it implies that output increases more than proportionally as input increases, which doesn't align with the linear nature of the model. So here option D is incorrect. Then question number 114, find the odd one in its shape. ABC, SC, MC, AFC. Very simple. SC curve is U shape, then this is ABC and this is MC. These all are U shape curve, but AFC shape is just rectangular hyperbola. AFC, downward sloping rectangular hyperbola. So the odd one is AFC curve. All are U shape. SC, ABC, MC are U shape, but AFC is rectangular hyperbola. Shape of AFC is rectangular hyperbola, downward sloping. So here option D is different from all of these. Then question number 115, consumer demands a good because of the characteristics of the good and not the good itself that give rise to utility. This is called as theory of revealed preference, Lancastrian demand theory, ordinal utility analysis, or cardinal utility analysis. This is called as Lancastrian demand theory. Because Lancastrian demand theory proposed by Calvin Lancaster suggests that consumers derive utility not from the goods themselves but from the characteristics or attributes that the goods possess. So this contrasts with traditional theories that assume consumers derive utility from the goods directly. So this is the means contrast or opposite concept to the other theory. So Lancaster's demand theory, it suggests that consumers demand a good because of the characteristics of the good and not the good itself that give rise to utility. It is called a Lancastrian demand theory. Then question number 116, if a firm has no dominant strategy, it is called, if a firm has no dominant strategy, it is called as prisoner's dilemma, pure strategy, saddle point, Nash equilibrium. When a firm has no dominant strategy, it is called as Nash equilibrium, because in a Nash equilibrium, no player has a dominant strategy. Instead, each player's strategy is optimal given the strategies of the other players, and no player has an incentive to deviate unilaterally from their chosen strategy. So it is called as Nash equilibrium if a firm has no dominant strategy. Then question number 117, factor not affecting increase in supply. Factor not affecting increase in supply. When technology improve, supply increases. Government policy improve, supply increases. Natural resources availability also, when natural resources available, then supply also increases. But price and supply is not directly related, because price affect the quantity supplied, not the supply itself. Price, it affect the quantity supplied. So changes in supply are influenced by factors such as technology, government policy, natural resources availability. So price changes cause movement along the supply curve, means changes in the quantity supply, but they don't shift the supply curve itself. So price here, factors not affecting increase in supply is price. Then question number 118, identify the wrong one. Identify the wrong one. When marginal cost falls, average cost also falls. Yes, when MC fall, AC fall, then when AC rises, MC also rises. These are from, you can see a different concept like so when marginal cost fall, when MC fall, then average cost also fall here. Then when AC rises, average cost rises, then MC also rises. MC first is MC also rises, then MC curve caught the AC curve at its lowest point. Yes, then average cost caught marginal cost from AC caught MC from below. No, MC caught AC from below. MC caught AC from below, but not AC caught MC from below. This is incorrect. This is the reverse concept. So this is incorrect. Option A, B, C are true, but option D is incorrect here. So option D is right. Then question number 119. If MPC is equal to 1, then the saving function is, if marginal propensity to consume is equal to 1, then the saving function is dash. Non-linear and non-proportionate, linear proportionate, linear non-proportionate, horizontal straight line coincide with the baseline. Yes, when MPC is equal to 1, then the saving function is horizontal line coincide with the baseline, because the MPC is equal to 1, it means that all additional income is spent and nothing is saved. So therefore the saving function would be a horizontal straight line at 0. So it coinciding with the baseline, indicating no saving regardless of income. So it is called as MPC is equal to 1, then the saving function is horizontal straight line coincide with the baseline. Then today's last question, economic growth leads to increased welfare, increased standard of living, more goods and services, advanced health and educational services. When economic growth leads to more goods and services, it is the direct linkage, more goods and services, because economic growth primarily refers to an increase in the production of goods and services in an economy, while this can potentially lead to improvement in welfare, standard of living and health and education services. The immediate result of economic growth is the expansion of output. So it more goods and services. So here economic growth leads to more goods and services. Option C is. So this is all about for the today's session. I hope you enjoyed this video. If you really benefited from this video, please like, also comment in the comment section, also share with your friends and subscribe. And thank you all for watching. See you in the next video. Thank you all. Jai Jagannath.